I appreciate you tuning in to another video from Netpicks, and today we're going to discuss the 930 trading method. And I'm sure most of you have heard about this use of moving averages, but today we're going to dive into it just a little bit deeper. And in case you haven't heard of it, it's a 2 moving average crossover pullback strategy. And for it, we use a 9-period EMA, the exponential moving average, and the 30 WMA, which is the weighted moving average. And basically, it's a trading setup that we can use to join the current trend direction. And we also can note the trend via the moving averages. So the 9-period EMA, that's the short-term average. The 30-period WMA is a long-term moving average. The space between the averages, that's the pullback zone. We can call it an area of opportunity. When we have the 9 above the 30, we are looking at a market in uptrend. The 9 below the 30 is a downtrending market. And frankly, when we talk about markets, you can use it on any market and your time frame doesn't matter. Just know that lower time frames can produce a lot of whipsaw price action when you use moving averages. So how do you trade it? Well, really, it's a simple strategy. However, it doesn't matter how simple it is. You have to have your rules defined long before you trade with it. So let's talk about a buy setup. The 9-period EMA has to be above the 30 WMA. Price will pull back and close in the space between the averages. And a buy stop order is placed above the high of the candlestick that closed in the area of opportunity. The short setup is the opposite. The 9 EMA is below the 30. Price is going to pull back, cross into the space between the average. A sell stop order is placed below the low of the candlestick that closes in that area of opportunity. And that's that. Quite simple. This chart. The red lines, they are the stop placement using the average true range. The green lines are where the trade exited due to hitting the trailing stop loss. So overall on this chart here of a 4x pair, the Euro US dollar, it's a daily chart, 2 wins, 1 loss for a combined win of 22 pips. However, on the first 2 trades, prices did move 1 times the risk, and at that point, traders may have decided to scale out positions. So trade management matters. This is an example of day trading crude oil used in the 930 setup, and it's a long trade. And this trade actually traveled almost 2%, which gave a price increase of $1.05, which if you trade crude oil, you know that's a lot in terms of contract sizes. And traders do have the option of moving the entry orders closer to the price if new lower highs are put in for longs or higher lows for shorts. Now, it's easy to enter these trades, and sometimes using confirmation, it can cost you if price runs too far. But statistically, the break of a high or low of an individual candlestick, there's no edge there. But an edge is present in the resumption of a trending price pattern. Think about this. Higher highs and higher lows equals an uptrend. Lower highs and lower lows is a downtrend. So we want to watch for price to resume the trending structure. So how do we look for it? Well, a small chart is a daily time frame, and you can see we have a 930. So instead of using the high of the setup candle, we dial down to a lower time frame. In this case, it's a 4-hour chart. You can see the pattern of lower lows and lower highs shows the 4-hour chart is in a downtrend against the daily chart uptrend. And that's normal. A higher low is then put in, and we can take a trade entry when price breaks that last lower high, because now we have an uptrending price structure. And it's a simple price pattern, the trending price structure. And it makes sense. It's a resumption of the trend direction. It makes an excellent trigger for a 930 setup. How about a trend line? That's another method you could try as a trade trigger. And sometimes it can be difficult to draw a proper trend line, and that depends on the price action. But multiple time frame trading can help you do that. And this chart is a 1-hour chart, but the setup was on a daily chart. Now the 4-hour chart did not have any swings that we could use for a trend line, so I needed to go down to the 1-hour chart. And the entries marked with the green arrow, and some traders may wait until the moving averages cross back in the direction of the higher time frame trend before the entry. That's just added confirmation. What about our stop loss and profits? There are quite a few ways to set your stop loss because you want to protect your risk capital. And below the low for a long is pretty simple. Is it effective? Well, we want to keep our stop out of the market noise. And one way we can do that is using the ATR for the stop loss. Profit targets, they're going to depend on your style, long-term or a short-term trader. You have options to take profits using multiples of your risk, trailing stops, or using previous swing highs or lows for your price targets. This is a CFD chart of natural gas, and I marked the setup with the green arrow, and we're just going to use the break of highs for the trigger. So we're going to use, from the lows, a 2 times the 14 period ATR, and that's going to be our stop loss. And you can see the various target levels are at 1 times our risk, 2 times our risk, and 3 times our risk. And if you want to trail your stop, you could certainly use the 30 WMA just to keep things simple. And what about adding in support and resistance zones? And I think using structure with any trading system is a pretty viable addition to your plan. But the issue is going to lie in your definition of support and resistance. So whatever it is, ensure that the levels you choose are visible, ensure that they make sense, and they were an actual turning point in price at some time. And here on Bitcoin, you can see that the price is pulled back into the zone that has had price activity in the past. So the great thing about the 930 setup is that it forces you to zone in on a particular area on the chart for your setups. Because there are lots of price levels on a chart. And maybe, perhaps, the ones that show up in a zone of the average price, which is our distance between the averages, are more relevant than other ones. So let's wrap this up. Should you use it? Well, it takes into account trend direction, and it is pullback trading, and pullback trading does have a small edge in the market. It does keep you focused on certain areas on a chart. The stop loss placement is very simple. It has a built-in trailing stop using the 30 WMA. It's not a mechanical trading system, though. You might want to consider what makes a good pullback, and here's a video about it here called Pullback Failures. And using that information can actually help you avoid entering into trades that have a lower chance of working out. So I appreciate you watching. I hope you hit subscribe. And my question is, do you use moving averages and pullbacks like this 930, for example? If you do, let me know in the comments below. And thanks again for watching.